Now, the release of India's Q3 GDP numbers has definitely stirred up attention, and for good reason. Now, India's GDP recorded an impressive growth of 8.4% in the third quarter year-on-year, marking the strongest growth since the second quarter of 2022. Now, this figure not only surpassed expectations but also exceeded forecasts by a significant margin. Now, analysts as well as economists initially anticipated slower GDP growth for all of FY24. However, the robust performance witnessed in the first 3 quarters of the fiscal year has led most agencies to revise India's GDP projections for FY24 upwards. Now, in a recent development, the World Bank, in its latest South Asia Development Update on 2nd April, projected that the Indian economy would grow at 7.5% in 2024. Now, this revision represents a significant rise of 1.2% from its earlier projections for the same period. Now, meanwhile, the overall growth in South Asia is expected to be at 6% in 2024 alone. While India's economic growth is indeed commendable, there are areas of concern that deserve our attention as well. Now, despite the overall positive growth trajectory, certain segments are experiencing challenges. First is the private consumption growth. Now, most of the growth that we are observing is attributed to spendings by the central government, while private consumption growth remains subdued. Now, this indicates a potential imbalance in the drivers of economic growth. Second is the sectoral performance. Now, on the production side, the industrial and the services sector have exhibited strength. However, the agricultural sector has faced deterioration, posing challenges to the overall sectoral balance and the agricultural sustainability. Now, it's important to note that while there are pockets of pain, there's also optimism for continued improvement. Now, according to government estimates, the Indian economy is projected to grow at 7.6% in FY24 ending March 2024, positioning India as the fastest growing major economy globally. Now, what exactly is PMI, you may ask? PMI stands for Purchasing Managers Index, and it serves as a forward-looking indicator that offers insights into the operating conditions of the manufacturing sector collectively. Now, onto the latest figures. India's manufacturing activity showed continued expansion in the month of March, with the HSBC Purchase Manager Index, or PMI, for the sector soaring to 59.1. Now, this is the highest PMI reading in 16 years, which is quite remarkable. Now, it's worth noting that a PMI reading above 50 indicates expansion in activity, while a reading below 50 suggests contraction. India's manufacturing PMI has now remained above the key level of 50 for an impressive 33 consecutive months. Now, what's driving this surge in the manufacturing PMI, you may ask? Well, it's due to the robust increases in both output as well as new orders, marking the strongest performance since October 2020. Additionally, there's been a notable uptick in input inventories reflecting increased production activity. However, it's essential to approach these positive figures with a degree of caution, considering the broader macroeconomic landscape. While PMI provides valuable insights, it's extremely important to remember that it's a survey-based indicator and not a direct measure of actual production volumes. Now, let's juxtapose the PMI data with another key indicator, which is the Index of Industrial Production, or IIP. Now, the growth in industrial output slowed down to 3.8% in the month of January. This was actually below what analysts were expecting. Now, this slowdown suggests that despite positive signals from the PMI, actual industrial production might not be growing at the same pace. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment related documents carefully. Visit www.researchandranking.com.